For 72 hours in the autumn of 2024, the foundational rule of global finance shattered. When geopolitical fear spiked to a decade high, investors did not flee to gold, they fled from it. In less than 3 trading sessions, an estimated $10 trillion in perceived global wealth, the bedrock of sovereign reserves, pension fund hedges, and multi-generational family legacies, simply evaporated. This was not a typical market correction. It was a systemic failure of trust in the one asset engineered by history to survive systemic failure. The numbers, extrapolated from the stress dynamics of March 2020, but amplified by today's larger, more leveraged market, defy a century of financial doctrine. The spot price of gold plunged 28%, cratering from $2,400 to $1,128 per ounce. The SPDR Gold Trust, GLD, the world's largest gold-backed ETF, experienced a record-shattering single-day outflow of $18.7 billion as panic overwhelmed the fund's creation mechanism. The most critical failure, however, was structural. The arbitrage link between paper and physical gold, the fundamental law of one price, snapped. The premium for immediate, deliverable physical bars in London vaults swung to a staggering plus 24% over the collapsing paper futures price on the COMEX. This wasn't a price drop. It was a market undergoing a catastrophic schism, its two hemispheres violently splitting apart. Every modern portfolio theory model for 50 years had enshrined gold as the ultimate uncorrelated hedge, the non-dollar asset that rises when confidence falls. In its darkest hour, it became the epicenter of the panic itself. This crash exposed a terrifying modern truth. The gold, owned by most ETFs, funds, and investors, is not a physical metal, but a complex hierarchical web of financial promises and derivative claims. And in a true liquidity crisis, promises can break. How does the asset that survived the fall of empires, world wars, and hyperinflation suddenly become toxic? The answer lies not in ancient history, but in the hidden multi-trillion-dollar leverage of the 21st century gold market. A silent bubble that finally met its pin. The pin wasn't an economic report or a central bank decision. It was a mechanical failure in the shadowy, dollar-funded repurchase markets, starting 7,000 miles away from the legendary gold vaults of London and New York. The pin that pricked the global gold bubble originated not in a gold mine or a central bank, but in Tokyo. The trigger was a sovereign debt shock, isolated to Japan. After years of ultra-loose monetary policy, a surprise, hawkish pivot by the Bank of Japan, a definitive end to its yield curve control program, sent the yen soaring and Japanese government bond, JGB, yields spiking violently. For Japan's monolithic pension and insurance funds like the $1.6 trillion Government Pension Investment Fund, GPIF, this wasn't a market move. It was an existential event. It created an instantaneous trillion-dollar mark-to-market loss on their foundational JGB holdings, triggering urgent regulatory capital and collateral calls. Facing a binary choice, raise cash immediately or face insolvency, these institutions executed a forced liquidation playbook. Their U.S. Treasury holdings were also falling in value due to global contagion fears. Their global equity portfolios were far too volatile to sell in size without catastrophic losses. Their largest, most liquid, and regulatorily approved stable asset class was their gold allocation. Held precisely as a non-yen, uncorrelated stabilizer, it was now the only asset liquid enough to sell in the billions without prior notice. A fire hose of sell orders for GLD and IAU ETF shares, alongside block trades for thousands of COMEX gold futures contracts, hit global markets simultaneously. This was not a speculative bet against gold. It was a desperate, panicked funding exercise by the world's most conservative institutional investors. Trading volume in the gold ETF complex tripled within the first chaotic hour. The clearest signal of the unprecedented stress was in volatility indexes, which broke a decade of historical behavior. The CBOE 10-year Treasury Note Volatility Index, TIVX, and the CBOE, or COMEX Gold ETF, Volatility Index, GVZ, spiked in perfect, terrifying unison, shattering their long-standing negative correlation. This data point, observable on every professional trading terminal, confirmed a singular, ugly truth. Both classic, safe haven assets were now being liquidated for the same reason, a desperate need for dollar liquidity at any price. The documented theory of gold as a hedge against currency moves evaporated. In a cross-currency, liability-driven margin call, it transformed into the most convenient source of dollar cash. The initial selling from Tokyo was rational and focused on survival, but it landed with concentrated force on a Western paper gold market structure that was, unbeknownst to most, a carefully balanced house of cards. The first wave of Japanese selling didn't just lower prices, it triggered a cascading failure in the very arbitrage mechanism that makes the entire paper gold ecosystem function. The true crisis began not with the Japanese selling, but with the failure of the financial system's hidden safety valve. The entire legitimacy of paper gold, ETFs, and futures rests on a delicate arbitrage bridge linking it to physical metal. Under the tsunami of selling, that bridge collapsed. In normal times, authorized participants, APs, typically major banks, act as market mechanics. If an ETF like GLD trades below the value of its underlying gold, net asset value or NAV, APs profit by buying the cheap ETF shares, redeeming them with the trust for physical bullion, and selling that metal. This arbitrage keeps the ETF price pegged to gold. But on this day, the mechanism failed catastrophically. As GLD's price plunged below NAV, APs faced two impossible barriers. First, the short-term financing costs to buy the billions in physical gold needed for redemptions skyrocketed as dollar liquidity vanished. Second, and more critically, they faced paralyzing counterparty risk. Could the ETF sponsor S vaulting and logistical system handle an unprecedented flood of redemption requests without delay or failure? Faced with unknown liabilities, the APs paused all creations and redemptions. The arbitrage glue dissolved. Simultaneously, the futures market seized. The gold forward offered rate, GOFO, the rate for borrowing physical gold, plunged deep into negative territory, a condition seen only in extreme stress like March 2020. This meant physical holders were effectively paying to lend their metal, signaling an acute, panicked shortage of deliverable bars to meet potential future settlements. The paper and physical markets, designed to be conjoined, underwent a violent divorce. The result was a two gold prices reality. Financial headlines blared, "Gold crashes 20%, tracking the collapsing ETF and futures price. Meanwhile, the wholesale price for a 400-ounce good delivery bar in a Zurich vault for immediate settlement was trading at a 20% premium. The market had fractured. This schism didn't just lower prices, it destroyed confidence in the integrity of all paper claims to gold. The $10 trillion evaporation was not primarily a loss in bullion value, but a catastrophic collapse in the value of the leveraged financial promises built upon it. With the arbitrage broken, GLD transformed into a discounted, broken product. Seeing only the plunging number on screens, retail and institutional investors sold en masse, unleashing Phase 2, the systemic margin call from hell. With the arbitrage mechanism broken, the crisis shifted from fundamental to algorithmic. The financial system's own risk management protocols transformed a sell-off into a self-reinforcing death spiral. The initial volatility spike became explosive. Gold's 3-day realized volatility rocketed from a placid 15% annualized to over 80%, a level synonymous with market collapse. This surge triggered automated non-discretionary selling from two powerful systemic players. Volatility targeting funds, which mechanically reduce position sizes as volatility rises, were forced to dump gold exposure into a falling market. Simultaneously, risk parity strategies, which allocate based on risk, not dollar value, instantly identified gold as the portfolio's most volatile asset and sold it aggressively to rebalance, further crushing the price. The death blow was administrative. The CME Group's clearinghouse, acting on its mandate to ensure market integrity, announced an emergency margin increase for gold futures contracts of 35%. This prudent protective measure had a catastrophic secondary effect. For every hedge fund, commodity trading advisor, and leveraged speculator, the directive was simple. Post millions in additional cash collateral immediately, or your positions will be forcibly liquidated by the exchange. A unified, panicked scramble for dollars ensued, triggering a fire sale of any liquid holding to meet the calls. The contagion spread instantly to the mining sector. Major gold producers, whose equity valuations are hypersensitive to the gold price, saw their shares crater 40-60% in a session. Many carried significant debt or had used futures to hedge future production at lower prices, locking in catastrophic losses. Fears of covenant breaches and outright defaults turned the sector's equity into toxic paper, creating a second, violent wave of forced selling. In London, the unallocated OTC market, the world's largest, built entirely on credit relationships, began to freeze. Facing unprecedented counterparty risk, major dealing banks initiated name give-ups, refusing to trade with all but the most solid partners. The system of trust that greased $250 billion in daily transactions seized solid. Liquidity vanished. The full scale of the $10 trillion Vanishing Act now became calculable. The loss encompassed the obliteration of roughly $1.5 trillion in global gold mining equity market capitalization, the vaporization of approximately $6 trillion in notional value from gold derivatives, swaps, and futures, the wipeout of $1.5 trillion in equity from gold-focused ETFs, closed-end funds, and mutual funds, and a final $1 trillion in contagion losses across correlated assets like silver platinum and commodity-linked currencies. This phase was mechanical and involuntary. Human fear was replaced by digital mandate. The selling was executed by risk models, margin clerks, and automated liquidation algorithms. The market was now cannibalizing itself. As the paper market imploded, a final logical hope emerged among shell-shocked investors. The physical metal market will save us. But the physical market had been silently weaponized by the very entities long entrusted as its stewards. As the paper market's death spiral deepened, the long-assumed savior, the physical gold market, failed to materialize. Instead, it transformed into another source of selling pressure and a theater of institutional failure, proving it was too small and compromised to arrest the systemic collapse. Central banks, the largest collective holders of physical gold, faced a brutal trilemma. Intervening to support the price by buying required deploying scarce dollar reserves into a crashing market, a politically untenable act of catching a falling knife. Holding steady inflicted massive, embarrassing mark-to-market losses on their official reserves, undermining their balance sheet credibility. For some emerging market banks, the choice was made for them. Needing dollar liquidity to defend their own collapsing currencies from contagion, they became forced stealth sellers of gold, adding unexpected supply to the maelstrom. The core of the physical market, the bullion banks, was caught in an impossible squeeze. Institutions like J.P. Morgan and HSBC, which facilitate the global gold trade, were trapped in a tri-party vice. First, they had lent significant physical metal to earn a yield and could not recall these loans instantly. Second, they faced ruinous margin calls on their short futures positions, which were meant to hedge their physical book. Third, panicked clients with allocated accounts and ETF holdings demanded physical delivery, a claim the banks could not immediately meet. To generate cash and metal for survival, they were forced to sell whatever liquid assets they could, primarily more paper gold derivatives, further accelerating the crash. This culminated in a formal market failure. On the COMEX, the number of futures contracts standing for physical delivery suddenly exceeded the available registered inventory in exchange vaults by a factor of 3. Faced with this impossibility, the exchange invoked its force majeure clause, allowing for cash settlement instead of metal delivery. This was the ultimate broken promise. The futures contract, S core pledge of physical delivery, was voided. The signal was catastrophic, triggering a final definitive wave of panic. The retail coin shop sellout was a $5 billion sideshow, a phenomenon of anecdotal, not systemic, significance. The soaring premium for small bars reflected a desperate scramble by wealthy individuals, not a mechanism capable of stabilizing a $10 trillion paper edifice. The physical market was revealed not as a foundation, but as a small, illiquid, and structurally compromised annex to the vast derivative complex. After 72 hours, the storm passed not because value was found, but because there were no more leveraged longs left to liquidate. The market was broken, and the global financial landscape was permanently scarred. In the rubble of the 72-hour collapse, the global financial system did not merely reset, it was reconfigured. The assumptions governing capital preservation for half a century were declared obsolete, replaced by a stark new hierarchy born of traumatic failure. 1. Gold's Great Demotion. The most profound shift was the intellectual and institutional downfall of gold. It was formally recategorized by index providers and asset allocators from monetary asset, or safe haven, to volatile commodity. 5 decades of correlation data, which had underpinned its role in modern portfolio theory, were discarded as statistically irrelevant. Major pension funds like Japan's GPIF and global insurers announced strategic reviews, leading to drastic, permanent reductions in their strategic allocations. The 5,000-year store of value narrative was broken in 3 days. 2. The dollar's Pyrrhic, absolute victory. The sole beneficiary was the U.S. dollar, specifically in its most liquid, shortest-term form, the 3-month Treasury bill. The crisis proved a brutal axiom. In a true systemic liquidity black hole, the only guaranteed safe haven is the direct liability of the sovereign entity that can create liquidity at will. The U.S. dollar index, DXY, soared to 20-year highs, but this reflected a terrified flight to sovereign power and necessity, not a vote of confidence in American economic management. Safety was now defined by coercion and monopoly, not trust. 3. The regulatory reckoning and controlled markets. Regulatory agencies launched a barrage of investigations and proposals. The SEC floated rules allowing ETF sponsors to suspend creations and redemptions during periods of extreme volatility, effectively permitting them to break during crises. The CFTC proposed draconian position limits on gold derivatives for all but bona fide commercial hedgers. Bullion banks faced mandatory stress tests on their physical and derivative books. The result was a gold market that became less liquid, more controlled, and far less attractive to institutional capital. 4. The unallocated model's terminal crisis. Trust in the London over-the-counter unallocated gold system, a market built on ledger entries and credit, was irreparably shattered. A slow, expensive structural migration began among surviving institutions toward fully allocated, bar-specific custody. in jurisdictions like Switzerland and Singapore. This fragmentation permanently reduced system-wide liquidity and increased holding costs, cementing gold's demotion from a trading asset to a costly, static store of wealth for a wary few. 5. The mining industry's nuclear winter. With equity valuations decimated and debt markets closed, exploration and development financing evaporated. A wave of bankruptcies and distress mergers consolidated the industry into a handful of survivors. Multi-year projects were canceled. This collapse in capital expenditure planted the seeds for a severe physical supply shortfall a decade later, but that future scarcity was irrelevant to the present reality of a collapsed demand paradigm. This outcome defied the documented historical expectation of a V-shaped recovery for gold after crises. The 2024 event was not a dip. It was a verified permanent regime shift. The asset did not regain its monetary status because the underlying confidence in its market structure was annihilated. This scenario is not mere fantasy. It is a plausible stress test of the market's actual layered architecture, and the chilling proof of its possibility was demonstrated not in a hypothetical model, but in real time during the glaring preview of March 2020. The hypothesis of a gold market collapse is not speculative fiction. It is an extrapolation of a documented near catastrophe that already occurred. The March 2020 dash for cash was the live fire drill, and the market failed the test. The events are preserved in official records. As the COVID-19 panic peaked, gold, the ultimate safe haven, fell 12% in 8 days, while the S&P 500 cratered 34%. This perverse move was accompanied by all the hallmarks of systemic failure. The physical premium for bars in London spiked to multi-decade highs, the arbitrage between the LBMA and COMEX markets broke, and the gold forward offered rate, GOFO, went deeply negative. As the Bank for International Settles, BIS, reported in its June 2220 quarterly review, the core issue was a severe shortage of US dollars that froze the gold funding market. Settlement between central banks and bullion banks nearly failed. The system was hours from seizing. Only a historic, unprecedented intervention by the Federal Reserve, flooding the globe with dollar swap lines, provided the liquidity to prevent a full-blown cascading collapse. The crisis was contained for 3 critical reasons. First, the Fed's response was historically fast and colossal, backstopping everything. Second, the stress was a pure dollar liquidity crisis. Faith in gold's intrinsic value remained intact. Third, the volatility unfolded over weeks, allowing mechanisms time to adapt. The BIS's conclusion was stark. The episode highlighted structural vulnerabilities in the market, specifically its fatal reliance on fungible and unencumbered liquidity that vanished instantly when needed most. The system survived only because the central bank backstop worked perfectly. This is the critical lesson. In a future crisis, where central banks are part of the problem, like a sovereign debt shock, or where political constraints delay or dilute their response, the outcome would not be a recovery, but a collapse. Today's amplifiers make a repeat more dangerous. Higher baseline interest rates make funding stresses more acute and costly. Enormous government debt levels potentially constrain the scale and speed of fiscal and monetary firefighting. Most critically, geopolitical fragmentation makes the kind of seamless, trust-based central bank coordination seen in March 2020 far less certain. The documented view of March 2020 as a weird anomaly is dangerously complacent. It was, in fact, a verified stress test that revealed critical, unaddressed fault lines in the foundation of the global gold market. Understanding these fault lines allows us to see the potential triggers hiding in plain sight today. The 72-hour collapse was not a random event, but the predictable result of 4 interdependent pillars failing in sequence. This paper gold edifice, valuing claims at over $12 trillion, relies on all 4 simultaneously holding. Pillar 1, unbroken arbitrage. This is the sacred link between paper claims and physical metal. It requires the frictionless, low-cost ability to exchange an ETF share for a bar of gold or a futures contract for delivery. This mechanism is the foundation of trust, convincing investors that paper is as good as gold. It broke temporarily in March 2020. In a faster, more intense crisis, it wouldn't bend, it would shatter permanently, divorcing paper price from metal reality. Pillar 2, abundant, cheap dollar funding. The entire arbitrage machine runs on cheap, reliable US dollar liquidity. Bullion banks and arbitrageurs must finance massive physical holdings to keep the system balanced. A global dollar shortage or a sustained period of high interest rates, a higher for longer regime, makes this financing prohibitively expensive or unavailable. When funding dries up, the arbitrage engine seizes. Pillar 3, unquestioned counterparty trust. The system is a web of promises between ETFs and their sponsors, futures traders and clearinghouses, and bullion banks and their clients. It requires unwavering faith that every party will honor commitments during a panic. The March 2020 strain and subsequent regional bank crises have already eroded this trust. A major failure by a single key player could trigger a domino effect of default across the chain. Pillar 4, the low volatility assumption. The mountains of leverage built upon gold and mining company debt, hedge fund positions, and volatility targeting strategies all assume the asset exhibits moderate hedge-like volatility. This assumption is embedded in risk models and margin calculations. A sudden, sustained spike in volatility, like the move from 15% to 80%, doesn't just change the price, it triggers forced algorithmic selling from these very models, creating a self-fulfilling prophecy of instability. As the Bank for International Settlements concluded, the gold market came under strain not because of its own inherent problems, but because it was plugged into the broader financial system. The crash occurs when the broader system, under its own duress, calls in its loans to gold, demanding dollar liquidity and exposing each fragile pillar. With these pillars known to be structurally shaky, the only remaining question is what specific catalyst might deliver the coordinated knockout blow. The leading candidates are already present on the global economic stage. The vulnerabilities are mapped, the pillars are cracked. The final element is identifying the plausible near-term catalysts, already visible on the horizon, that could exploit these flaws and trigger the cascade. Trigger 1. The sovereign default liquidation spiral. A major emerging market sovereign default, perhaps in Pakistan or Egypt, unfolds not in isolation, but through the global banking system. Western financial institutions with heavy exposure face immediate massive mark-to-market losses. To maintain capital ratios and cover these losses, they liquidate their most liquid, high-quality collateral. At the top of that list, gold ETF shares and futures positions. This forced institutional selling provides the initial shockwave that breaks Pillar 1, arbitrage, and begins the volatility spike. Trigger 2, the reverse Nixon shock. Financial war. A geopolitical rival coalition, seeking an alternative to dollar hegemony, announces a functional gold-backed trade settlement system. The U.S. and allied response is not diplomatic, but financial, a declaration of economic war. They initiate a coordinated, overwhelming attack on the paper gold price, using sovereign lending facilities to flood the market with thousands of tons of synthetic supply. The goal? To destroy the credibility of gold as a stable anchor, thereby wrecking the rival system. This direct state-sponsored assault simultaneously shatters Pillar 1, arbitrage, Pillar 3, counterparty trust, and Pillar 4, low volatility. Trigger 3, the bullion bank counterparty run. A significant player in the London gold market, a major bullion bank, succumbs to a scandal or a catastrophic loss in an unrelated trading book, e.g., commercial real estate. As it faces failure, the OTC market freezes. Counterparties refuse to trade, fearing exposure. This sudden total evaporation of trust and liquidity in the unallocated system, Pillar 3, triggers a panicked run on all paper claims as clients demand physical delivery, a demand that cannot be met, revealing the fractional reserve nature of the market. Trigger 4, the Treasury volatility doom loop. A failed U.S. Treasury auction or a violent inflation scare sends long-term bond yield volatility soaring. This triggers the automated, non-discretionary selling protocols of massive risk parity and volatility targeting funds. Their models, detecting spiking risk in all safe assets, force them to sell U.S. Treasuries and gold simultaneously in a correlated dump. This selling is of such scale and speed that it overwhelms the arbitrage mechanism from the very first trade, directly attacking Pillars 1 and 4. The common thread is stark. Each trigger exploits gold's fatal interconnectedness with the leveraged, fragile financial superstructure built upon it. The problem is never the metal, but the system's dependence on perpetual liquidity and trust. This reframes the entire analysis. The documented search among investors for gold, AES next bullish catalyst, is potentially a dangerous misallocation of attention. The critical monitoring must shift to systemic risks that could render it violently, catastrophically bearish. For an investor, this changes everything. The primary goal is no longer predicting gold's price, but engineering a portfolio to survive its potential failure as a reliable asset class. The $10 trillion crash scenario is the ultimate lesson in liquidity transformation risk. The gold in most portfolios is not a metal, but a complex promise of a metal, layered with leverage and entirely dependent on perpetual market calm. When that calm breaks, the promise can shatter. This reality demands a new, pragmatic framework for hedging true systemic risk once the primary historical hedge is deemed unreliable. The post-gold resilience framework, if you must hold gold, reconfigure it as explicit, illiquid insurance. This means owning physical, allocated bars in a stable, non-banking jurisdiction, accepting high custody costs and low liquidity. All other forms, ETFs, futures, unallocated accounts, and especially mining stocks are not gold exposure. They are a separate high-risk bet on financial engineering and market structure. The true cash is king asset. In a modern liquidity black hole, the only universally accepted collateral is the direct short-term liability of the sovereign that controls the reserve currency. This means owning 3-month U.S. Treasury bills directly or via a Treasury-only money market fund. Diversify across uncorrelated crises. Build hedges for different disaster modes. Consider productive farmland, inflation, hard asset, cybersecurity infrastructure, digital warfare, defense contractors, geopolitical risk, and resilient logistics, supply chain dislocation. The goal is not a single safe haven, but a mosaic of non-correlated necessities. Focus on utility, not just store value. In a true systemic reset, tangible utility outweighs financial abstraction. Direct control or access to essential resources, energy, water, food production, and practical skills hold more enduring value than any digital portfolio entry. The Bank for International Settlements 2020 analysis ended with a critical, verified warning. The interconnectedness of markets means that liquidity strains can propagate in unexpected ways. Gold is not an isolated sanctuary. It is a deeply embedded node in the global financial network, and it can fail if the network fails. Therefore, conduct a ruthless stress test. Would a 30% gold shock in 72 hours cripple your portfolio? If so, your hedge is an illusion. Rebuild your safe haven around assets that cannot be vaporized by a margin call or a broken arbitrage. For 5,000 years, gold survived the fall of empires. The defining question for our financial age is whether it can survive the failure of modern finance itself.